cost of living, interest rates. Today, the Reserve Bank will meet. It's likely interest rates will rise by either 0.25 or 0.5 percentage points. Calculations from Rate City show that 2.5 percentage points of rate rises so far this year have added 29.4% to the cost of mortgage repayments on a 25-year loan. And if rates rise a further 0.25 of a percentage today, that will mean mortgage repayments have risen 32.6% since the start of May. Peter White is the Managing Director of the Finance Brokers Association of Australia. Peter, good morning.
Good morning. Thanks very much for having us on this morning.
Not a problem. Now, the Reserve Bank, would you expect that 0.25 raise will come through?
Yeah, I'm hoping amongst all hopes it'll only be 0.25. We're seeing trends happening in other countries around the world where it's going higher than that and upwards of 0.75. Now, that won't happen here, but there is a chance if Reserve Bank only goes 0.25%, they'll do it again before Christmas. So, do we rip the Band-Aid off now and take the jump at 0.5, or do we wait and see if we're up for more after today? But certainly at least 0.25 today.
All right. Now, for someone who has a $750,000 variable home loan, if that rate does go up by 0.25, how much extra is someone paying per month or per year?
Yeah, if the rate does go 25 basis points, you're going to be looking around $111 a month extra. Now, it depends on the term of your loan. More loans these days are taking 30-year loans, so I've worked out on a 30-year loan basis.
Yep.
If you're on a 25-year loan, it's going to be higher than that again, but it's going to be at least about $111.
All right. But sorry, I was going to say 0.5 of a percent?
Yeah, $224.
Okay.
Yeah,
gee, there must be a lot.
There
must be a lot of people just holding their breath.
Oh yeah, and it's a terrible time. I'm so disappointed that we didn't start this journey a long time ago. Rates are always going to go up, but when we're doing this in such a short period of time after succession, it really hurts a lot of people. And it would have been far smarter to have more smaller increments over a longer period of time than these huge steps we're trying to take at the moment, especially with the rising cost inflation.
And when could that have begun? Like, as you're watching on, are you thinking this was something we should have been doing a year ago, 2 years ago?
A year and a half ago, beginning of last year. Yeah, and even small little steps. It's easier to adjust to small little steps, 0.1% or whatever it may have been. But starting to work towards the fact that inflation was going up. Obviously, the eye was off the ball a little bit there by regulators. That we could never sustain these long-term rates. We could see what was starting to happen around the world, and all the markets were moving, and we were just slow off the pace. But we're all heroes in hindsight, so maybe I should let that one go. But you look at it now and go, this is so hurtful. And there's some challenges still to come. It's not over yet. There's a lot of people taking fixed rates, so they're a challenge.
Peter White's Managing Director of the Finance Brokers Association of Australia. We're just talking about the interest rate rises that have been so far, and another one expected to come through this afternoon. So what are mortgage and finance brokers telling you right now about the mortgage market?
Yeah, so it's actually something that's been happening for a fair bit of time this year as rates have gone up, and that is people are getting trapped with their own lender and in their own mortgage structures, even if they want to vary it or take a better deal, because of the servicing rates or the buffer rates that are applied when you go for a new loan. So we call them mortgage prisoners. And what it is that you may be able to afford the loan, but you may not meet the servicing criteria, because servicing is based on 3% above the variable rate. So if the variable rate at the moment is, let's call it even money 4%, you've got to show that you can service a rate at 7%. If we go up 25 or 50 basis points today, whatever it is, that increases again in line with that. So it's always 3% above. So, there's a point where we've got to look at this and say, well, is it reasonable still to have this mandate through APRA that says you've got to have, it's at least 2.5%. Banks have the option to make it more, and most of them exercise that. And I don't necessarily agree with that. But we're seeing in different countries in Canada and UK at the moment, where governments are having conversations saying, should we reduce or maybe get rid of the buffer rate for people who have existing mortgages and are not increasing it? So you're just taking up a better deal.
Yeah.
And there's some sense in that I don't know about getting rid of it altogether. That might be a step too far. but certainly reducing it from what we're seeing here from 3% down to maybe 2 to 1.5%. So bring it right back, because there's a point in time you're going to get to, well, interest rates aren't going up anymore, so why am I being penalised by having this rate that's higher than the market? Now, from a lending perspective point of view, this sort of regime's always been there, but it does move around from time to time, and we're unusual times now, and I think we've got to be very careful that we don't actually stall a marketplace and the economies that are supported by it by having these rules that no longer make sense.
Yeah. What about...
And that's a big issue.
Peter, what about the idea that, that could get people into financial hardship if we don't have those buffer zones?
Well, that's fine when you're in a low interest rate market that's rising, because you're then protecting the future repayments. But we've seen over decades and decades in this industry where these things actually don't have as big an impact as what discretionary spending does. So what we just generally sort of see is surplus income or surplus money from our salary, and we just spend it on whatever, and we enjoy ourselves, and that's all perfectly fine and reasonable. But it's discretionary spending that sometimes can be tricky. Australia is one of the biggest users per capita in the world of credit cards. Now, so that sort of spending, we need to rationalise and make sense. I'm not saying get rid of it, but we need to maybe realign our expectations, and we're coming into Christmas, and I don't want to be Christmas Scrooge, but maybe we don't spend as much as what we would like to, or what we did through COVID. In COVID, we weren't travelling or doing anything, so we had lots of extra money. We were stuck at home.
The jewellery shops were going crazy, I can tell you that right now.
Yeah, exactly. And they love us all to spend that bit. But we've also got to watch our own personal situations, and you still may be able to, your own personal situations. But we just got to watch how that plays out. And that's why I originally said that with that servicing or buffer rate, I don't think we should completely get rid of it. I think there's a reasonableness that says with responsible lending that you have that little margin there just to make sure as a buffer. But you've also got to remember there are other criteria in lending as well. It's not just the servicing rate that comes into play for affordability. It's assessment of what your current commitments are, what that discretionary spending piece is like. And then there's...
a whole lot of other things as well.
There's stats and data that comes into it that sort of plays it all out.
Peter, I'm going to have to leave it there, but it's been great having a chat. Peter White, Managing Director of the Finance Brokers Association of Australia.